Good morning, traders. Chris Buss here with Traders Profit Compass with your morning look at markets for Wednesday, February 17th. Okay, today I want to take a look at, or at least discuss, the COVID case counts and hospitalizations. Then I want to get into bond yields and its implications, and then roll into renewables and commodities. And then we'll jump into our normal review of the indexes and FATMAAN names. Okay, first up, we got a few things on the economic calendar today. We've got retail sales, I think comes out at 9 o'clock, if not 10 o'clock. We've got industrial production, and we've got the FOMC minutes at 2 p.m. Now, the FOMC minutes, at least in recent memory, I can't remember it ever moving the needle, but there'll be a lot of discussion about it, of course, trying to read the tea leaves of what was said in the meeting, etc. And for a long time, I thought the FOMC minutes were literally the minutes, a secretary writing down everything that was said, in a transcript and then publishing it. That's not the case. It's sterilized, right? They may give you a flavor of, what kind of discussions were held, but it's not. It's not a verbatim transcript, and I thought that was interesting. I don't know why I thought they would even consider letting people in on actually being at the meeting, but that's what I thought for a long time. So anyways, okay, we had a big yield spike yesterday in the 10-year. We were up 8% in yield. This is a chart of the 10-year Treasury yields, TNX. We've got the history of it. This is going back 2 years of 3% back here, falling down to 50 basis points, bouncing around 50 basis points for a lot of 2020. And then in August of last year, we've gone from 50 basis points up to 1.3%. And really the interesting thing here is, well, not only the rising channel, but remember, we had the big spike coming into the new year where we went from 90 basis points up to 1.19, something like that. Then we pulled back to the 1% level, bottom of the channel, and then we've gone straight up since over the last 2 weeks. And it doesn't seem like a lot, but it's 30%, 30 basis points on a 1% yield up to 1.3. That's a 30% rise in 2 weeks, which is dramatic. Now, the thing I want you to take note of is, let's look at the resistance points. As I've got it drawn here, we're going to reach the top of the channel somewhere around, let's say 1.35, maybe 1.4, depending on when it gets there. But your real resistance is going to come in at 1.45. And that's where the rubber will really hit the road as far as breaking above that level, getting into the, the 1.5s, the 1.6s. And, if that happens, then, we'll probably go just like we talk about in equities. Once you drop out of a range and then recapture that range, the automatic target is the top of the box. So if we pop 1.45, get into this 1.5 area, chances are yields will at some point flash the top of this box at 2%. So doubling from where we were in February. Now, part of the reason for this, if you go to the blog site, at tradersprofitcompass.com, and actually there's a link in the show notes for the site. You'll see on today's post that I have all the COVID, the latest 7-day moving averages of the COVID. We've got cases, new cases, we've got hospitalizations, and we've got deaths. And in all three instances, those numbers continue to roll over and dramatically drop off, especially in cases and hospitalizations. If you look at deaths, it's still too high, and it has rolled over, but it hasn't dropped off a cliff. And my only explanation for that is, if you go in the hospital, it's serious, right? I think your chances of running into a serious problem once you enter the hospital is highly elevated. And I think, it's going to come down. It is coming down. It just hasn't. The shape of the curve is more elevated than the shape of the curve in the hospitalizations and the cases. But as those cases come down and the hospitalizations come down, the death rate will follow. And the point of all this is we've got vaccinations on the rise, and we've got and we've got cases and hospitalizations, death rate coming down. And I think the market is looking forward to a robust reopening period in the economy, with heavy pent-up demand and consumption in the quarters ahead. As the vaccines take hold and are more widely distributed amongst the population, that feeling of safety, of getting out, mingling, and conducting economic activity increases. So that's driving the yields. That's driving the cyclical names. And so as long as those COVID rates continue to come down, I think you're going to have a bid in yields. I think that's going to put continued pressure on TLT, and I think that's going to keep a bid in your cyclical type names. So let's dive into it a little bit more. Here's TLT, and of course, rising yields is bearish for TLT. And we've been on this trade pretty well for the last several months at least, into 21. We tried a short here on this breakdown of this 151 level. We got stopped out when it bounced back for a back test of 153, 154. We re-entered the short with a February 151 put. We got that move. We rolled down to the March 147 puts with price near 148. We had to sit through a little bit of a kickback, but then in the last several days, price has just fallen apart here. So that trade is working really, really well. I've got a projected measured move from the right descending triangle that points towards a measured move of 138. But notice this high volume over price bar where there was some consolidation in TLT before. So I think price is going to fall into this 142 area and consolidate for a while. And then as time goes forward, if there's upward pressure on rates due to the economy continuing to heat up, then I think you'll see the break. And then I don't think it's going to stop at 138. So, if you were not in the trade, from up here, I don't think you want to, unless there's a little rally in prices that would, kick that up into a bear flag. I don't think you want to try to get short here after this move. If you get a bear flag, yeah, then you got an objective way to get short and look for that 142. But that's where I would be looking to cover that those March 147 puts. Take profit there and then look for a breakdown. I will tell you, on the order flow front, the institutional order flow, I did see quite a bit of put flow in TLT looking out into June for prices down here below 140. So, I think some big money is looking for TLT to fall further, for rates to rise. And of course, when rates are rising, that's good for banks. This is the KRE Regional Bank Index. Last week, in the weeks prior, we talked about this consolidation below 58, 59 area. Last week, we got the breakout. I distinctly remember pointing that out. And now this week, we've got follow through. And so, as long as rates continue to rise, those are going to be bullish tailwinds for the banks. Now, here, I don't know if you want to just, dive in at 62 and a half. What you may want to do is just keep an eye on this. And if rates, drift lower back down to the bottom of that channel, that's going to bring this price most likely back in for a back test of this breakout. That's the point where I think you want to be a buyer of KRE. And, that would give you some exposure to financials. And I think they're going to do well in the next, 6 months as we reopen and there's pressure on rates to go higher. So I think that would be a gift if you got that pullback right into here. Here's XLF, same deal. Breakout, move up. If you got to move back into the trend line, I think you can be a buyer there. I don't know if you just want to jump in at this point if you're not in already. Watch it closely, try and get a pullback. Posting this chart of DW CRE, which is the Dow Jones Industrial Group for renewables, and it was down 5% yesterday. And the reason I throw that up there is just because of all the stuff that was going on in Texas, probably still is going on, where their grid basically broke down with millions and millions of people out of power, with their wind turbines all froze up, their solar not working, their Tesla's not working because you can't plug them in because there's no power. Just a little bit of a wake-up call on the green energy space, that fossil is going to be with us a while, and until the ESG crowd sees the light of nuclear energy, right, to handle the base load of the country going forward. I mean, we're talking for decades, not, the next couple of years. This is a decade-long thing. You literally, there's not enough acres in the country to put solar panels on to operate, the country on solar. I don't think it's physically and feasibly possible. So if the green movement wants carbon-free energy, really one of the only ways to do it is embrace nuclear. With the decision path is, adopt a nuclear and then spend the next 50 years figuring out what to do with the waste rather than fighting it and fighting carbon. So those are some decision points. But all I'm saying is, yesterday, traders pumped the brakes on renewables. Here's TAN. To a lesser degree, this is a solar ETF. Still in a strong uptrend. I'm not saying the thing's going to roll over. In fact, here I would be setting an alarm at 122.50, and if you get a breakout there, buy it, because you've got a $15 wide trading range here, and if you pop 122.5, you're probably looking at 140. So I would be a buyer there. So anyways, but within the whole context of things, oil is through $60 now. It's up 1% this morning. And I didn't mention it. I started the video at about 6:45 this morning with all the indexes relatively flat. But the big green one today, as it has been lately, is oil, up 1% and through $60. And keep this in mind. Throughout 2020, there was literally no capex in oil and natural gas. Everybody was pulling in their horns, and let's stay in business in 2020, and we'll worry about production growth down the road. Don't forget that fracked wells have a pretty aggressive depletion curve, and it hasn't hit yet. But I think you're going to see a production drop-off here over the next 3 to 6 months, where that lag from the non-investment in 2020, coupled with the depletion curves from the operational wells over the past 9 months to a year, I think you're going to start seeing that in production, and that's going to be a bullish tailwind for oil prices if supply is throttled. And also, there's a big OPEC meeting coming up on April 1st, where they're going to be taking a look at their production, and they've been remarkably disciplined lately to keep supplies in check, and that has contributed to this run up. I think we can see $75 oil here, into June, in the summer, as driving picks up, as air travel picks up. I think you're going to see a steady bid in oil. That doesn't mean it's not going to consolidate. It doesn't mean it might not pull back, but I think you're going to see a bid stay in the oil stocks. And lastly, before we get into our standard fare of indexes and FATMAAN names, I want you to take a look at the CRB monthly. This is the Commodity Research Bureau tracking index for commodities. Everything is in this: oil, grains, aluminum, copper, iron ore, cattle, everything commodities is in this index. And what we see here's a 40-year support and resistance line that goes back to 1973, okay? Long-standing line in the sand. And we broke that level back in 2016, and we were hovering, back and forth. And then in March of this year, the bottom fell out. So this big recovery in commodity prices, in oil and copper and all that kind of stuff, has simply brought us back to where we were. So from that standpoint, yeah, you missed the trade from here to here. But from that standpoint, all this has done is brought us back to a 10 12 year bear market. Because look, in 2008, the index was at 473. Now we're at 187. So way less than half of where we were. What's the point? If price can pop this monthly downtrend line and clear this 200, which I have as lateral resistance right along here, if the commodity index can pop 200, it may be an emerging sign that the 12-year bear market in commodities is coming to an end and a new bull market is emerging. What could drive that? Well, just the things that we've been talking about: oil, EV adoption is going to drive copper. That's Freeport, FCX. That's Southern Copper, SCCO. A demand pickup, iron ore, BHP, Vale, Rio are some names that you can take a look at. But everything, aluminum names, grains, corn, soybeans, all that stuff have all been in terrible, terrible 10, 12-year-old bear markets. And if there's anything that we know, things don't go up forever and things don't go down forever. So we're at a point right here where there could be a massive inflection point. And if inflation picks up, that's a big tailwind for commodity prices, right? That's what it is. When you know that copper is going to cost more 3 months from now than it does today, that drives that consumption of people pulling those buys forward because they fear it's going to be more expensive down the road. That's what inflation is. And if you look back in market history, that was a 1970s environment where it was a commodity-driven, massive commodity bull market. And then in the early 2000s, it was a China-led bull market in commodities as their economy expanded, etc. So watch for that inflection point. We missed a lot of this stuff, to be frank, but I think if there's going to be a move, it's just beginning, and I want to be ready for whatever breakout may happen in the months ahead. So let's look at SPY. Pretty dead day yesterday. We were flatlined. We opened higher. That was immediately faded and brought price back below our midpoint of the channel. Looking at the 30-minute chart, key off 391.50. I think that's your pivot point. As long as 391.50 holds, I think we can go higher. If 391.50 fails, I think good chance we pull back into 389, and that would be a place, if you're an active trader, that I would be looking for a tactical $2 short, but I would be looking to cover down here at 389, 388.50, right in that area. Qs were also a little soft yesterday. Down 0.27%. Opened higher. We talked about yesterday, don't get all excited in the first 5 minutes trying to, grab the uptrend. Let the market settle in, and sure enough, they did backfill that gap. They brought it right back to this trend line, the top of the channel, and then hovered there the rest of the day with nothing much going on. looking at the 30-minute chart, I would be keying off of 335, even though it's slightly below this rising channel. I think there's a lot of support right here at 335. You can see how many touches there were along that line from a couple of weeks ago. And so that line should now become good support. If that doesn't hold, I think you could see 333 and possibly a back test of this low here at 331 or 330.50. So I would be keying off at 335 today. I think that's your pivot point for active trader, bulls and bears. Above is okay to be bullish. Below, I think you got to lean bearish for a tactical trade. IWM was pretty soft yesterday. Opened up near 230, and they faded it the whole day down here into 225, 226. But in the scope of things, after this big run up, consolidation here is probably a healthy thing. As far as tactical trading today, I've got a line here at 225. As long as 225 holds, I think, bulls or being long is fine. You can look for a move back up to 227. If 227 were to be recaptured, I think that's a buy point as well. Looking for 230. But if 225 doesn't hold, I think you come down here and test this top of the gap again. And if things get broadly more soggy, probably fill that gap down to 221.50. So I think 225 is a good pivot level to key off of. Let's quickly go through FATMAAN. Facebook has been, not going to say a weird trade, but kind of a difficult trade. Has not given a lot of easy places to get in. We had consolidation rage, and then a big impulsive candle. You had to get that quick, and then you've had to either trade the range or just sit tight with a longer duration position. Yesterday, another big impulsive candle out of the gate, reached all the way up to our 276 next overhead level, tagged it, and then backed off. So now we've got another bull flag forming here. I think you can be a buyer against 272, and you can be a buyer on a breakout above 276. So it's been methodical. It has not been altogether impulsive, but it's grinding its way higher, and just consolidating at each new level. And now we're here in the middle of this range between 272 and 276. Like I said, I think you can be long against the bottom, or wait for a breakout here and look for 280. Apple's been really soggy. Yesterday, we talked about 135.5 as being the pivot. That worked great. Fake breakout above, lost it. That was your chance, if you were gonna or motivated to get short against 135.5, and you got 250 out of it after it broke below this 134. Now, price is vulnerable here, right? Because we had this trading range between 134 and 137.50. We've now dropped below. This looks like a little bear flag. Price is vulnerable to come down to this 130.50. So if you got a kickback, a little bounce this morning into 134 that looks like it's going to fail, that it has trouble popping through, I think you can take a tactical short there and see if this doesn't, roll over, because now the measured move on this breakdown is 130.50 to test this prior low. And, that's the technical picture. And, in your technical studies, this is the H cell breakdown. Here's the the you know, the tall part of the H, and then here's the, you know, envision a small H on the alphabet, you know, down, down, and then here you have a decision point. Does it break and follow through, or does it hold the line and come back up? But right now, from a technical standpoint, this is vulnerable down to 130.50. Tesla continues to wrestle with 800. They faded it all day yesterday, down $20, 2%. Fake breakout, lost the Friday close, and that was a potential place where if you were interested, you could have gotten short, and then, you know, it's flirting down here in this 795, 800 range. Technically vulnerable to come down here to 775 and test the gap. I would continue to use 800 as your pivot point if you're actively trying to trade it. Microsoft, a whole bunch of nothing, continues to frustrate anybody like me that keeps thinking, you know, every time it pops up to 245 is going to be the breakout. It's just not a good trade. So it remains in this lockdown range between 244.50 and 240. I think it's going to eventually pop, but you know, you just got to be patient and set your alarms and just be ready. Amazon, nice example of, you know, nothing going on in the broader markets, but a lot going on under the surface. Yesterday, we pointed out this little breakout here, which is the first, you know, impulsive bar above this downtrend line, and it was really interesting. The first bar had a reach back candle that got to 253.59. Right? So our free 50 club says, you know, be long against 32.50 and look for 3300, right? For the free 50. You got that in one bar. Boom. Came back to 32.53. That was your opportunity to buy, and actually we had somebody in the trading room actually buy that right then and there, and they got a quick, you know, within the hour, a $50 move, and then they closed out. And then circumstance would have it that then the faders hit it and dropped it back below 3,300, and then, you know, the free 50 club on the downside, a breakout above 3,300 followed by a move back into the trading range, favors a move back down to the bottom of the box, and you got it. You got a move, this candle, and then a reach down candle that got very close to 32.50, right back in that 32.55 range, and then it oscillated the rest of the day. So, I mean, another opportunity to grab $100 or so dollars, you know, whether it's 90, whether it's 80, whether it's 75. These levels continue to work great in Amazon. Google, big impulsive move out of the range, reached all the way up to 2140, and then they faded it the rest of the day. I really like Google long here against 2100. You know, if you can tolerate $10 of risk to be long Google on this breakout, I think that's going to be golden. And you know what? If it fades, that's the chance you take. You know, if it moves back into this range, if the Qs and everything falls apart, that's the risk you take. But this is a very common technical move. Impulsive breakout, profit taking, back test the breakout, and then go. I would be an interested buyer right in this area against 2100. Netflix, nothing day, continues to consolidate. I think you can be long against 554 and look for higher prices. If you lost 554, I think you're coming back at least 10 bucks to 545 and possibly lower. So, okay, long video today. Let's do a quick recap. We got retail sales. We got industrial production today. We've got FOMC minutes. We've got a rising rate environment that is bullish for banks and cyclicals and commodities as the COVID metrics, the 7-day averages of cases, hospital stays, and deaths all roll over. That's tailwinds for the reopening trade, right? And if there's a COVID relief package that comes out of Congress here soon, that'll be even more tailwinds for the reopening and the market in general, as you know, all this money floods out into the system. That's usually inflationary, so we'll have to see how that affects it. Watch your commodities. I threw out a lot of names, not going to go through those again, but look for entry points in steel, in aluminum, in copper, in all things commodities. We might be on the dawn of a commodity renaissance in a more inflationary environment as the CRB index looks to take out 12-year downtrend resistance on the monthly chart. I've given you the key levels on the indexes and FATMAAN trades, or FATMAAN names. Watch those for you active traders. We'll see if today is more or less more consolidation, or if there's a gentle rollover or pullback, or if we can break out. So never a dull moment. Hope you found the video helpful. If you're new to the channel, hit the subscribe button, hit the alarm bell, pass a link along to people in your trading group that may find it beneficial as well. Look over in the show notes for links to the blog site and how to register for all my content, where you'll get everything in an email package each and every time with trade alerts and market updates throughout the day. And you'll also get an invite to our trading room. It'd be great to have you. A lot of aspiring and hardworking traders in the room that are all there helping one another. So, longer video this morning. Hope you found it helpful. So, until we talk again, this has been Chris Buss with Traders Profit Compass. Talk to you next time, and have a good day of trading.